Hey there, awesome accounting student. Mark Franke here. Today, this video is on Accounting 101, Chapter 8, where we're going to do some plant asset transactions. And this actually is going to be using problem 8-3B and 8-5B. Got some more papers for you to use. And so the first problem has to do with a bulk purchase. In this case, we bought some land and a building and some building improvements. And so in order to allocate the purchase price, we need to base it on relative market value. The actual purchase price was $1,550,000. And when we had these things appraised, the land was appraised at $795,200. The building B was $482,800, and then the improvements to the building, and the improvements include the parking lot, maybe landscaping, other things that are around the building, but not the actual building. So normally when we talk about land improvements, we're talking about fencing and hardscape and landscape and pavement, parking, striping, that kind of stuff. So now when I add them all up, it's $1,420,000, which means we paid more than the appraised value of this property. This is very common because oftentimes the location, or maybe it's whatever, there's a reason why the person who bought this, the company that bought this, was willing to pay a little more than what the actual appraised value was. But now what we're going to do is we're going to calculate the percentage of each one of these categories to the total by just merely dividing the appraised cost by the total appraised value, so that I can get a percentage, and they should obviously add up to 100%, and they do. So now I'm going to multiply the purchase price times the percentage to get the amount of the purchase price that is allocated to each one of these assets. The land is going to have now a cost of $868. The building B is going to have a cost of $527, and the land improvements B is $155. So we're going to now plug these into my schedule down below. So that what happened is we bought this land and we built another building. So one of the things we had to do, we had to demo some either structures or something that was there. We paid $122,000. That goes as part of the land. Then we had to grade the land. That means we had to bring in some big equipment and smooth the land so that it was flat enough to be able to build a new building. And we're calling that building C, which is $1,458,000. And then we also did some improvements to building C, again, parking, landscaping, hardscaping, fencing, whatever it was. And that was $103,500. So our total cost now for the land is $1,164,000. The building B stayed at $527 from our allocation. Building C, we spent $1,458,000 to build this building. Improvements B came down from the allocation, and then we also spent some money to the new building, building C. So now we can make our journal entry. And our journal entry is going to look like this. This is going to be dated on January 1st of 2019. We have land, building, B, building, C, land improvements, B, land improvements, C. And we paid cash for everything. Whoopsie. Okay. And I am going to just say to record purchase and improvement of plant assets. Now, normally we would have an address of where this was or some other information we could put in here, but we don't have that, so we'll just do it this way. So my land is going to come over at $1,164,000. The building B, 527. Building C, $1,458,000. Land improvements B, 155. I'm just linking these in Excel using the equal sign, and then I will sum these up, and my total purchase price is $3,408,000. Then they've asked us at 1231 to calculate depreciation on all of these guys. So I'm going to do the first one. This is going to be a straight line method. They all use a straight line method. And so I have a depreciation expense and accumulated depreciation. And this is to record depreciation on building B. We have the cost, the estimated salvage value, which gives us total depreciation, the estimated life in years, and so the annual depreciation. So the cost in this case, and I'll just link it from up above, is 527. And let me make this a little smaller so you can see both, okay? Our estimated salvage value, they gave it to us in the book, was $99,500. So our total depreciation is $427,500. This is a 15-year life. So my annual depreciation is $28,500. Okay, you're going to do the same thing. I'm going to stop the video. I'll calculate it on building C, on improvement B, and improvement C. Do these calculations, pause the video, and then bring it back, and you can see if you got the right answers. And this is in your book on page 335. Salvage value for building C is $258,000. There's no salvage on the improvements, and that makes sense. No salvage value on the improvements. The useful life for the building C is 20 years. For improvements B is 5 years. And for improvement C is 10 years. Okay, so stop the video and do those calculations, make the journal entries, and I'll be right back. Okay, I'm back, and here is the calculation of depreciation on building C. The annual amount is $60,000, debit depreciation expense, credit accumulated depreciation. On the land improvements B, it's $31,000. There's no salvage value and a 5-year useful life. I went ahead and I included the estimated salvage value in there just to show somebody that salvage value is 0. Not essential to do that, but I like to do it just so that somebody doesn't come back and say, hey, what about the salvage value? And then on the land improvement C was 10,350, 103, and this was a 10-year useful life. So hopefully you got those calculations. And let's move on. We're going to go to problem 5B, and this problem is all about what happens when we sell an asset that we've used. So this is on page 335. So this is going to take an asset from the beginning when we bought it. We're going to depreciate it. We're actually going to have a modification of the depreciation, and then we're going to sell it. So I've got a journal for you for this problem. This is York Instruments, problem 85B, and the date is January 1st, 2019. Oh, it just says year 1, but I'll use 19. And we're going to debit machinery and credit cash. We paid cash for this piece of machinery, and this is to record purchase of machinery. Again, if we had a serial number or a better description of this, we would put it in here so that somebody knows exactly which piece of machinery. You can imagine if we had a factory and we had a bunch of different machines, we want to be able to identify these. And most of the time, companies take a little sticker or a plate or something, and they literally put an ID number, their own internal ID number, on each piece of machinery, which is a really, really good idea. So we have the cost of the machine. Oh, by the way, they told us that the estimated useful life, and I'll go ahead, was 6 years. And the estimated salvage value is 9720. Okay, so we have a little bit of a calculation because we have the cost of the machine and some sales tax. And we would include the sales tax in the cost of the machine. And if there was freight to bring it in, if there was some sort of an installation fee, we would include all of that in the cost of this equipment. So this is the total purchase price. And we will now just link into our journal entry up above, and we have a debit of $114,270. Okay, I'm going to stop the video, pause the video, and I want you to calculate depreciation on 1231 straight line method, and I'll be right back. Okay, I'm back. Here is the depreciation for the first year. Very, very straightforward, just like we did in the other problem. We took the purchase price, subtract the salvage value, divided by the estimated life, and 17,425 is the amount of depreciation. Then in the second year, they realized that this asset really isn't going to be a 6-year asset after all. They realized that actually it's probably only going to have a useful life of 4 years. And then they also gave us a new salvage value. So what we have to do is, this happens, we're talking about an estimate, but we're not going to go back and change the general ledger for the first year. We'll just affect this transaction and the depreciation calculation based on our new estimate. So I'm going to copy this journal entry, and modify it for year 2. So this would be 12/31 of 20. And I'm going to add a couple of rows in here because I need to actually calculate the book value. So let's go ahead and get rid of that. We're going to, well, I'll just leave that. But what we have to do is say the original cost or purchase price, and that is the $114,270. We have accumulated depreciation that is from what we recorded last year. So this is now going to be the book value. Our estimated salvage value has now changed to $14,345. And instead of 6 years, it's 4 years, but we've already done 1 year last year. So we have 3 more years to go, and we're going to just debit depreciation expense and credit accumulated depreciation for that $27,500. This is what happens when we change our estimate. Change our estimate. So moving forward 1 year, we have the exact same journal entry at 12/31/2021. It's the same thing. I'm just going to copy and paste it. Easy peasy. Control C to copy, Control V to paste. The only thing that we have to make sure we put in here is the accumulated depreciation amount, and the purchase price should have been the same. Everything should stay the same. And oh, yeah, I linked to the wrong one. All right, so let's fix that. Here we go. Okay, so point is, this journal entry at the end of 2021 is exactly the same as the journal entry we made at the end of 20 because nothing changed. We just rolled it forward 1 more year. And then on the end of year 3, this is on 12/31/21, we sold this piece of machinery for $25,240. $25,240. So I'm going to record that down here. I need to add a few rows. So I'm going to right click and insert some rows down here. And then we'll make this journal entry when we sell it. So what we have to do is when we sell this, and this is 12/31/21, we take the depreciation for that 3rd year, right? And then and now after we've taken the depreciation, we're going to figure out what the book value is, and then we'll record the transaction that we sold it. So we know we're going to have some cash that came in, and that cash is $25,240. $25,240. That's what we got for the machine. We know we have to take the accumulated depreciation off the books. So the accumulated depreciation at that point in time is the $27,500 for, well, let's start at the beginning. The $17,425 for year 1, the $27,500 for year 2, and the $27,500 for year 3. Those were our 3 years that we made a depreciation. So that accumulated depreciation account had that balance, $72,425 for years 1, 2, and 3. We also need to get rid of the machinery. And it was originally $114,270. So this is to record sale of machinery. Again, if we had another identifying number, we could do it. The book value, which is the cost minus the accumulated depreciation at that point in time, is $41,845. The cash we received is $25,240. So we have a loss. $16,605 is the correct number, and that will be a debit loss on sale of machinery. In other words, we sold this for less than our book value. It was on the books at that point in time, $41,845. We sold it for $25,240, so we have a loss. That's going to be a debit. It really is what it takes to balance out that journal entry. We got to record the cash we received. We want to get rid of the accumulated depreciation on that asset. We want to get rid of the machinery on for that piece of machinery, and then whatever it takes to balance that entry. If it's going to be a credit, it'll be a gain. If it's a debit, it's a loss. In this case, it's a loss and it's a debit. Okay, so that's it for Chapter 8. Thanks for listening. I'll see you again next time.